Something happened on May 6th that a lot of people in mainstream financial media glossed right over. Silver jumped 6.01% in a single trading session. Now, for most assets, a 6% move in one day would be headline news. But because silver lives in this strange in-between space, part industrial commodity, part monetary metal, part speculative playground, most people just shrugged and scrolled past it. That's a mistake. Because when you zoom out and look at the full picture of what is actually happening right now, across manufacturing floors in America, inside the vaults of the major commodity exchanges, and in retail coin shops in Tokyo, that 6% move stops looking like random noise and starts looking like a signal. A signal about inflation, about economic stress, about the growing gap between financial paper and physical reality, and about what that gap might mean for investors who are paying attention. So in this video, we are going to break all of it down clearly. We will cover silver's 37% correction and why it matters, the historic 25.6% jump in manufacturing costs and what that stagflation signal is telling us, the 6-to-1 paper-to-physical leverage situation on COMEX and why it creates real fragility, and finally, the extraordinary 60% retail premium currently being paid in Japan and what that says about global confidence in paper markets. We will connect all of these threads, give you a clear framework for thinking about what comes next, and do it all without hype, without fear tactics, and without pretending anyone has a crystal ball. Let's get into it. Silver entered 2026 with real momentum. Back in late January 2026, the price climbed to what was a multi-year high. There was energy in the market, media coverage picked up, and that familiar buzz around silver was back. And then, as it often does, silver pulled back hard. By late April and early May, silver had fallen roughly 37% from that January peak. That is not a small correction. That is not a healthy pullback. That is a significant decline that would have genuinely hurt anyone who bought near the top. Understanding why that decline happened is important context for understanding why the May 6th surge matters so much. Silver's correction was not happening in isolation. It was part of a broader pullback in commodities, driven by concerns about slowing global economic growth, a stronger dollar during stretches of that period, and anxiety about whether industrial demand would hold up in a weakening economy. Silver is particularly sensitive to growth expectations because roughly half of all silver consumption globally comes from industrial applications: solar panels, electronics, electric vehicles, and medical equipment. When the economy looks shaky, industrial demand gets priced down quickly. And when industrial demand falls, silver often drops faster and harder than gold, because it does not have the same deep monetary demand cushion that gold carries. So here is the situation heading into early May. Silver is sitting 37% below its recent high. The broader economic picture is getting more complicated, not less. And then on May 6th, silver surges 6.01% in a single day. Not on news that the economy is booming. Not on a surprise interest rate cut. It surged on a day when the economic data was, if anything, genuinely concerning. And that is exactly the heart of this story. Let's talk about that economic data, because this is where the stagflation signal lives, and it is the first major piece of the puzzle. The Institute for Supply Management publishes a monthly survey called the Manufacturing Index. It is one of the most closely watched economic reports in the United States. The people being surveyed are not economists sitting in offices. They are purchasing managers, the actual human beings who buy raw materials, negotiate with suppliers, and manage the real-world cost of making things every single month. One of the most important components of that survey is called prices paid. It measures the percentage of purchasing managers reporting that they paid higher prices for their inputs this month compared to last month. When that number surges dramatically from one reading to the next, it means inflationary pressure building inside manufacturing is accelerating fast. The most recent prices paid reading came in representing a 25.6% jump from the prior period. To put that in perspective, moves of that magnitude are historically rare. This is not a situation where costs ticked up slightly. This is a situation where purchasing managers across American manufacturing reported, in overwhelming numbers, that the stuff they need to make their products got significantly more expensive in a very short window of time. Think about what this actually means on the ground. Imagine a company that makes household appliances. They need steel, copper, plastics, and a dozen other raw materials. Last month, those inputs cost a certain amount. This month, the cost of those same inputs jumped materially. The company has limited options. They can absorb the increase and watch profit margins shrink. They can pass it to customers and hope demand does not fall off. Or they can slow production and try to wait it out. Whatever they choose, there is a cost. And when thousands of companies across every sector of manufacturing are making those same calculations simultaneously, the ripple effects spread through the entire economy quickly. Here is what makes this moment particularly dangerous. This manufacturing cost surge is not happening inside a strong growing economy. It is happening against a backdrop of slowing growth, weakening consumer confidence, and genuine questions about whether the economy can maintain its current pace. When you get rising prices on one side and slowing growth on the other, economists have a specific name for that combination. That name is stagflation. Stagflation is feared because it traps policymakers. In a normal inflationary environment, central banks raise interest rates, growth cools, inflation comes back down. The playbook is well established. Stagflation is different. Prices rise not because everything is going great, but because of cost pressures, tariffs, supply disruptions, energy shocks, things that make producing goods more expensive even as demand is flat or falling. To fight inflation, you raise rates. But raising rates slows borrowing, slows spending, and slows growth further in an economy that is already struggling. Cutting rates to stimulate growth risks making inflation worse. It is a genuine trap. The last sustained stagflationary period in the United States was the 1970s. That decade is instructive for silver specifically. At the start of the 1970s, silver was trading around $1.50 an ounce. By January 1980, it briefly touched $50 an ounce. I am not predicting anything like that from here. That would be irresponsible. But the historical precedent for silver performing strongly in stagflationary environments is real and documented. When investors face an environment where both stocks and bonds are struggling to maintain their real value, they look for alternatives. Silver, with its dual role as both industrial input and monetary metal, has historically been one of those alternatives. That historical context is part of what fueled the May 6th surge. Traders who watched the ISM data closely saw that prices paid number and immediately started pricing in a higher probability of a stagflationary scenario. Silver responded. That is the first piece. Now let's get into the second piece, which requires understanding something about how commodity markets actually work. I am talking about the COMEX paper-to-physical leverage ratio, the 6-to-1 situation that most financial media never properly explains. COMEX is the primary exchange in the United States where silver futures are traded. A futures contract is an agreement to buy or sell a specific quantity of silver at a specific price on a future date. In theory, these contracts represent real silver that could be delivered. In practice, the overwhelming majority are never settled with physical delivery. Traders buy and sell them as financial instruments, and when contracts expire, they settle in cash. This is a well-understood feature of futures markets, not a bug. It provides liquidity and allows price discovery. The problem arises when the ratio between paper contracts and actual physical metal gets stretched to an extreme. Right now, the ratio of outstanding paper silver contracts on COMEX to the physical silver actually sitting in COMEX registered vaults is approximately 6-to-1. 6 ounces of paper claims for every 1 real ounce of silver that is actually there. Think about it this way. Imagine a parking garage with 100 spaces. The owner sells passes to 600 people. Most of the time, this works fine. Not everyone shows up simultaneously, the lot never truly fills, and the business collects far more revenue than the physical spaces justify. Now imagine a major event nearby, and suddenly all 600 pass holders arrive at once. There are 100 spaces and 600 cars. The math collapses. People are turned away, the passes lose their perceived value instantly, and the system reveals itself to have been operating on confidence rather than reality. A 6-to-1 paper-to-physical ratio operates on the same principle. It works perfectly as long as most contract holders are happy to settle in cash and never demand actual metal. But when confidence in the paper system starts to erode, when investors begin preferring real silver over a paper claim on silver, the price has to adjust. And it does not adjust gradually. It tends to move sharply because suddenly you have a mismatch between what is physically available and what the paper market has been pricing as if it were available. Now, I want to be fair here. There are credentialed analysts who will tell you this ratio is not a crisis in waiting, that futures markets are designed to operate with leverage, that the delivery mechanism works as intended, and that concern about this ratio has been raised many times without dramatic breakdown. Those arguments have real merit. The system has absorbed elevated leverage before, but the counter-argument is equally real. The system absorbs that leverage precisely as long as confidence holds. Confidence is not a constant. It is a variable. And right now, several indicators suggest that confidence in the paper pricing of silver is being tested. Which brings us to the third and most vivid piece of evidence. Japan. Right now, if you walk into a coin shop or reputable precious metals dealer in Japan and try to buy physical silver, actual coins or bars you can hold in your hand, you are going to pay approximately 60% above the global spot price. Not 5% above. Not 10, 60%. If the global spot price is, say, $32 an ounce, Japanese retail buyers are paying roughly $51 an ounce. That gap is not a dealer markup. Normal dealer markups account for perhaps $1 to $3 on a transaction like that. The rest, that extraordinary $19 per ounce gap, represents a physical scarcity premium. It represents what happens when real people who want real metal start competing for a supply that cannot be printed the way a futures contract can. Why Japan specifically? Several pressures converge there right now. The Japanese yen has been in a prolonged weakening trend for the better part of 3 years. For a Japanese saver, that means the money in their bank account purchases less in real terms every year. Imported goods and global assets become more expensive relative to the yen. Add to that the fact that Japan, after literally decades of deflation, has started experiencing genuine consumer price inflation for the first time in a generation. Japanese consumers who have lived their entire adult lives in a deflationary environment are now confronting rising grocery prices, rising energy costs, and the quiet erosion of purchasing power. For a culture that values savings and financial prudence deeply, that experience is profoundly unsettling. Japan also has a rich tradition of physical savings, tangible assets that cannot be devalued by a government policy decision or a central bank balance sheet expansion. When economic anxiety rises in Japan, gold and silver coins and bars are historically among the first places savers turn. Combine that cultural instinct with yen weakness and the shock of returning inflation, and you get exactly what we are seeing. Demand for physical silver so intense that it has completely overwhelmed local supply, forcing prices to a 60% premium over what the global paper market says silver is worth. Here is the deeper point that matters most. Japan is not a developing country with limited access to global financial markets. It is the world's third largest economy with a sophisticated investor base that has full access to futures markets, ETFs, and every form of paper precious metals exposure available. And yet Japanese investors are choosing to pay 60% more for real metal rather than accept the paper version at the lower price. That is a statement about trust. More precisely, about the limits of trust in paper financial instruments when your currency is losing ground and your economy is under pressure. This is how divergences between paper markets and physical markets begin, not with a dramatic announcement, but with ordinary people in ordinary shops quietly deciding they want something real. One transaction at a time, they reveal that the paper price and the physical reality are not the same thing. Japan is showing us that gap right now, in real time. If you are finding this breakdown useful, please hit the like button. It genuinely helps this video reach more people trying to understand what is happening in the economy. And if you are not subscribed yet, now is a good time. We do this kind of analysis regularly here on the channel. Now let's talk about what might come next, and I want to give you 3 genuinely plausible paths rather than one false certainty. The first is the stagflation confirmation path. Manufacturing cost pressures persist. Consumer prices follow. Economic growth continues to soften. The Federal Reserve finds itself trapped between fighting inflation and supporting growth. Physical silver demand globally follows Japan's lead. The paper-to-physical divergence on COMEX becomes impossible to ignore. Prices move significantly higher. This is the path the current data points toward most strongly. The second is the temporary disruption path. The elevated manufacturing costs turn out to be driven by specific and temporary factors: tariff effects that normalize, supply chain disruptions that resolve, energy spikes that come back down. The economy slows but recovers. Inflation expectations stabilize. The Japanese premium reflects a local supply crunch that corrects as more physical silver arrives. Silver settles into a more modest range. This is the scenario that thoughtful optimists believe is most likely. The third is the recession path. Cost pressures are the leading edge of a more severe economic deterioration. Companies lay off workers. Spending falls sharply. Industrial demand for silver softens significantly. Even if monetary demand for silver rises somewhat, the loss of industrial demand more than offsets it in the short term. Silver potentially falls further before eventually recovering. This scenario is genuinely possible and should not be dismissed. Which scenario plays out? Nobody knows. What I can say honestly is that the data is currently weighted toward the first scenario, the stagflation path, based on the combination of signals we have discussed today. But economic outcomes are shaped by decisions that have not been made yet, by events that have not happened yet, and by the complex interactions of millions of people responding to each other in real time. Humility about outcomes is not weakness, it is accuracy. What I can tell you with confidence is that the three signals we have covered are not noise. They are real data telling you something real about the state of the silver market and the broader economy. Whether you choose to act on that information and how depends entirely on your own financial situation, your risk tolerance, your investment timeline, and your specific goals. Nothing in this video is a recommendation to buy or sell anything. Please make any financial decisions in consultation with a qualified advisor who actually knows your situation. Let me bring everything together with a clean summary, because we have covered a lot of ground. Silver surged 6.01% on May 6 despite sitting 37% below its January all-time high. That combination, deep correction followed by a sharp one-day surge, reflects a market reacting to genuinely significant economic signals. The ISM Prices Paid Index posted a 25.6% jump, one of the sharpest increases in recent history, signaling that manufacturing input costs in America are rising rapidly at the same time growth is slowing. That is the definition of stagflation, and stagflation has historically been one of the strongest environments for silver as a monetary and inflation hedge asset. At the same time, the COMEX paper-to-physical leverage ratio sits at approximately 6:1, 6 ounces of paper claims for every 1 real ounce of silver in the vaults. That leverage creates fragility. If a meaningful shift toward physical delivery begins, the repricing can be rapid. And in Japan, retail buyers are paying a 60% premium above the global spot price for physical silver. Not a markup, but a market signal that the gap between paper silver and physical silver is already being priced by real buyers in real time. These signals do not guarantee any particular outcome. Markets are complex, policies change, and economic trajectories can shift. But they tell us this is not a normal moment for silver, and that the 6% surge on May 6 was not random noise. It was a response to real and significant underlying pressures that deserve your attention, whether you own silver or not. Because ultimately, this story is bigger than silver. It is about the relationship between the financial system built on paper, leverage, and trust, and the physical reality that underlies it. Silver is one of the clearest lenses through which to see that relationship right now. And what that lens is showing us, in the ISM data, in the COMEX vaults, and in the coin shops of Tokyo, is a relationship under genuine stress. Pay attention to it, not with fear but with clear eyes and honest curiosity. That is everything for today. I am John Smith, this is John Smith Aero 2, and I will see you in the next one. Take care.